All right, welcome back to the Financial Beast podcast. And we're going to do another Between Two Erics, where, of course, we take complex financial topics and we make them ultra simple because that's our jam. And at least that's what I do. I don't know about you. But
I try.
Yeah, you do.
I try.
So today we're going to tackle a topic that, quite frankly, I think a lot of people, at least of our clients that are in their 30s, 40s, and 50s, don't really think about too much. But the statistics should say otherwise. And that is long-term care. So
long-term care.
Why don't you define long-term care for me?
Yeah, so long-term care is, I don't know if you want to call it end-of-life care because it's not always end of life, but it generally is end-of-life care. And what long-term care is things like home health care. If you need a nurse to come to the house to help with something, or you need to go into assisted living, a nursing home, hospice, all of those are long-term care scenarios. Okay. And really the basic definition, if you want to get down to it, long-term care is the inability to do two of the 6 activities of daily living. And activities of daily living are things like feeding yourself, being able to sit down in a chair and get back up, being able to go to the bathroom unassisted, groom yourself. I don't know, there's 2 others that I'm forgetting right now. But anyways, once you're unable to do 2 of the 6, you're considered in need of care. And that's the standard definition. Whether you're looking at private long-term care, whether you're looking at Medicaid, it's 2 of the 6 ADLs is the definition of long-term care.
Okay, good. So I think we got that defined very well, as a matter of fact. You must have prepared for this podcast because you knew I was going to ask that question right there.
No, I'm just the long-term care expert.
So that's pretty well done. So, all right. But I guess the struggle with it, well, I mean, I think it all depends on the person. I mean, we have clients that are getting into their 40s and 50s who are now starting to witness elderly parents that are having struggles.
Yeah.
And most of them don't have the resources to be able to pay for their own long-term care.
Oh, yeah. I would say experiences with family members is what drives when clients come to us for the long-term care discussion. If they bring it up, 9 times out of 10, it's because mom or dad is in long-term care and they're seeing how expensive it is and how much of a drain on the parents' assets long-term care is.
Yeah. So when we have this like under the protection umbrella, because when we have when we're looking at someone's financial life and we're saying, all right, like we have to look at the protection of your assets. Now, when people say protection of assets, I think they automatically think of like, oh, I'm going to get sued.
Yep.
So lawsuits, which is true. Okay. Or protection would be like insurance of, my automobiles or my house or things like that. Or they would think protection, like just like basic health insurance or life insurance or things like that. What does long-term care protect? I think you kind of touched on it right there.
Yeah. Long-term care protects your savings.
Yeah.
It is protecting your assets, like literally and figuratively. And that's one of the biggest misunderstoods about long-term care is people think, oh, health insurance or Medicare is going to pick it up.
Right.
I can assure you, health insurance and Medicare are not going to pick it up. You pay 100% of it out of pocket. And then when you're down to $2,000 of investable assets, then you can get on Medicaid and they'll pick it up.
That's it. $2,000.
Yep.
Wow. That's crazy.
Oh, and then when you die,
did they hit your estate up? The beneficiaries up for the cost?
Yep. Well, the beneficiaries aren't. So it's $2,000 to spendable assets, but like you can keep your house.
Right.
But once you die and your house is sold, Medicaid's clawing that money out of the estate.
Wow.
Yep. It's clawback feature.
That's crazy.
So yeah, it's best case scenario, it's gonna, put a sizable dent in what your kids inherit.
Okay. Well, why don't we go over some stats? And I want to ask you too about the typical cost of that as well. So I found this website that we're going to take a look at. I thought we were going to take a look at it. Where did it go? I'll get to this. 1 second. While we're doing that, what do you usually see the typical cost be for a long-term care?
Yeah, so as of today, and I have a great website for this actually, it's called the Cost of Care Survey.
Mm-hmm.
So let's look at Florida. In Florida, as of 2023, to be in a nursing home with a semi-private room, which means you're sharing a room,
Mm-hmm.
how much you think per month is the average?
I don't know. Give me it.
10 grand.
Jeez.
$9,885 to be exact. If you need a home health aide, so you need a nurse to come by 2-3 times a week to help with, whatever.
Yep.
$5,700 a month is the current average cost. And that's today. I mean, you can blow this out, 20 years. Nursing homes, same thing. Semi-private room is expected to be about $18,000 a month, and that same home health aide about 10 grand a month.
It's an enormous cost.
Enormous. And you can see, if I'm spending $18,000 a month, I've got to have millions in assets to cover that without blowing through my my basis per se.
Yeah, for sure. No, it's an enormous cost. I mean, I think it's one of these things. It's one of these risks that no one really understands until you actually go through it and you see it.
And it can be a double dipping scenario, because think about it. If I'm in care, right, and let's say it's costing 15 grand a month, my wife might not be in care and she might need another 5-10 grand a month to live off of.
Yeah.
So now I'm pulling 25,000 a month out of my assets. It's not sustainable long term unless you're, have an exceedingly large amount.
You'd have to have over 10 million in assets. Maybe not quite that much, but you'd have to have a lot.
You'd have to have over 5, doubt.
Over 5 million for sure.
Yep.
And at that point, you're really not able to leave. If one of your goals is to leave, assets to your beneficiaries and your kids, it's just going to royally screw up that plan.
Yeah, I mean, look at the stat right here. Average stay 3.2 years. So let's call it 39 months.
Yep.
39 months times 10 grand today. I mean, that's just about 400,000.
Yeah.
Today, let alone 20, 30 years from now.
Yeah. So let's look at the stats here and see what they say. So the latest available data says 70% of adults aged 65 years. This was in 2023 that I found this. So 70% of adults aged 65 years and older will require long-term care at some point. That's staggeringly high.
Yep. 7 out of 10.
Right?
That's been the stat for years.
So if you're 65 years and older right now, chances are that 7 out of 10, you're going to need long-term care at some point in time.
Yep.
So, and I can't imagine that stat's going to go down with the quality of healthcare and diet and lack of exercise and people taking care of themselves.
No, people aren't going to stop aging. And you know what? Even if you do take care of yourself, as you know, health things still happen. You know, we all age. I could be the most healthy person in the world. I'm still going to age.
Yeah, for sure. Next, 42%. Medicaid only covers 42% of America's long-term care costs. So I guess what we're looking at right there of all of it says $475 billion a year is spent on long-term care.
Yep. Yep.
Medicaid's only covering 42% of that. Is that how you read that? That still seems high.
It is. But remember, those 42% of people that Medicaid is covering
are broke.
Medicaid's only covering them because they're broke, because they've already spent through all their money.
Oh, yeah. They're broke.
Yep.
All their money's gone.
Yep.
At that point, all of your money is gone. Okay. And then I think this is an important one. 3.2 years is the average length of stay in a facility. And, just over 20% of residents will require care for 5 years or longer, which, it's not, that's not a statistical,
it's
improbability.
1 out of 5.
Yeah. Are going to be there for 5 years or longer. So you can see how the cost of that would certainly add up. But, this is important in how you structure your policy, right?
Yep.
Because if you're looking at the probabilities are 3 to 5 years, I don't think you'd want to have a policy structured for anything less than 5 years.
No.
Right. That you would want to help offset the cost on that one.
No. So, and I don't want to get too deep into this, but when you structure a long-term care policy, if I do, say, a 3-year benefit period, or I do a 6-year benefit period, it's not like the 6-year is half of the 3-year. They're much closer in numbers.
Yeah.
I know it's kind of a hard concept to put into words, but long story short, having a longer benefit period is not going to cost you much.
Yeah. Okay. And then you'd mentioned there's different types of facilities. And, I think we're looking at here another stat that says 28,000 assisted living and residential care facilities, which I think is where a lot of people start.
Well, yeah, long-term care is, like I said, it's generally end of life, right? So most of us don't wake up one day and go from mowing the lawn to, hey, I need to go into a nursing home.
Yeah.
It could happen if you had a stroke or something, but generally speaking, it's part of the aging process. So the aging process with long-term care, how does it work? Well, you get older. Your kids might stop by and help with groceries and landscaping and stuff like that. Then it becomes too much for the kids. So they keep doing their thing, and then they have a nurse come in as well. And then it's just too much. So now, okay, let's move mom to an assisted living. Mom does that for a year. It's not enough. Mom moves to a nursing home. Mom does that for a year or two. It's, not enough. Mom moves into hospice because now she's at end of life. So it's a progressive thing. It's not like, I'm fine today and I'm not tomorrow, usually.
Yeah, for sure. And then there's some gender differences too that I see. And this makes sense because men usually just go out, in a ball of fire and, we just like to just do it quickly. We don't like to sit here and endure, do we?
Nope.
So however that is.
Oh no, I can speak to this. My grandpa on my dad's side, passed away. I was 5 or 6. He cut the lawn. He was bagging up the grass, putting it in the trunk to take it to compost. Heart attack, dead in the front seat.
Yep.
My grandma's still alive today. Grandma's 93.
Yep.
She has dementia, unfortunately. She's in a memory care facility.
Yep.
And she's been there since 2019, I'm going to say.
Oh,
it was pre-COVID, so 18, 19. Well, when grandma went in there, she had, I don't know what she had exactly, but she had a good amount of money in investable assets. Every penny of it is gone. Every penny of my grandpa's pension, because he was a Detroit fireman, and her Social Security, everything goes to paying the facility, and it's not enough. The facility actually has like a charitable fund that's picking up the difference, but she's been in there for so many years that she sold her condo, and all of that money's gone to care too.
Yeah.
So when she passes, my father and his siblings, they're literally not going to get a penny.
No, nope. And I get it. Hopefully you plan for yourself and you're not dependent upon inheritance and any of those things, but still, it's still kind of rubs you wrong. Like, you could have done some planning on this.
Yeah,
and,
exactly.
You could have done something about it so that it did not, end up with just a drain of all the assets. So females this is really interesting. I didn't even know this. Like, long-term care residents are mostly females, 67 women for every 33 men.
Oh, that's so true. When I go and see her when I'm home in Michigan, it's almost all old ladies with tennis balls on a walker.
Yeah. Women stay in long-term care facilities for an average of 3.7 years, while men live in long-term care facilities for an average of 2.2 years.
Yep.
So I think it's even more important to start looking at, the females, in the household, because that the likelihood, the probability, the stats say that those are the one that are actually going to probably use the care a lot more than anyone else. Okay. Wow.
100%.
That's pretty fascinating right there. Any more statistics that we should look at in terms of?
No, I think that pretty well covers it. I mean, we know 7 out of 10 are going to go in, and we know on average, depending on our sex, we're going to be there for 2.5 to 3.5 years on average.
Yeah.
But,
I think
averages are averages.
I think this is kind of interesting. 55% of residents are 85 and older, so you can start looking at that means that most people that go in are going to be 85 years and older. 38 between 65 and 84, 7% are obviously younger than 65. But, this I think is going to dovetail into what we want to talk about next, which is like, okay, well, how do I solve this?
Yep.
And when's the best time to do it? What are the best kind of policies to look at and get? And, I think that's probably where we should spend the rest of the time. So let me just stop the screen here and we'll talk about that. So, what was long-term care like originally?
Yeah. So long-term care, I want to say it really started picking up steam in the late 80s, early 90s is kind of where the industry started.
Mm-hmm.
As most of us probably know, healthcare costs pre-1990 were much more manageable, but they have just, they've risen at 6% on average every year since. So healthcare costs to income has gotten way out of whack. So long-term care, as a result, started becoming more of a concern. Well, originally it started just like your car insurance, right? You pay a premium every month, every 6 months, whatever it is, and you have X amount of care benefits. And as long as you pay that premium, you have those benefits.
Mm-hmm.
Once you stop paying it, you don't. If you pay that thing the rest of your life and you have a heart attack and, like my grandpa did, and you're just alive 1 minute, dead the next, all that money that you paid in premiums is gone.
Got it.
So that's called traditional long-term care. And it used to work great. But one of the big issues, and we're seeing this today, is when these companies started issuing long-term care, their actuaries significantly were off in their math on how many people will need it and how much it will cost. So as a result, over the last 20 years, what's happened is the insurance companies have had to get rate increases.
So premiums have been jacked up since.
Yep. Just like your car insurance, right? Your premium might be $600 for 6 months today. When you go to renew, it might be $700.
Mm-hmm.
So they can increase the rate. And the problem with that is it's inversely related to one's income, right? Because as I get older, generally my income goes down, but my premiums are going up. And then, you might pay on this thing for 20 years and then you get to your late 70s when you really may need it.
Mm-hmm.
And I can't afford it anymore, so I let it go. That's been the biggest issue with traditional LTC.
Yeah. So all of those years that you paid into it, and there comes a point in time where you're just not making enough money and the costs are just way too much. So people just drop it.
Yep.
And they lost all that money.
Yep.
along the way.
And the rate increases, they're not going to stop anytime soon. With baby boomers, the biggest generation, going into care,
Yep.
and they're going to continue going into care at a record rate. Those rate increases are only going to continue to pick up steam until that generation's gone.
Okay. So let's talk about when to get it.
Now, yesterday.
Okay.
No,
So-
seriously, when to get it?
Yep.
The younger you are, the better.
Okay. So give me an age range.
You know, you really don't need to look at it in your 30s, but your early 40s is, in my opinion, the prime time to get it, because you're in your core earning years. You're generally still healthy, which, side note, that's a whole nother thing.
Yeah.
Long-term care is extremely strict, much stricter than like getting life insurance.
Okay, that's good to know.
Yeah. Yeah, if you wait, you're not going to get approved.
Yeah, let's talk about that right now. So the underwriting, because so these types of policies, there is underwriting that is required.
Oh yeah.
And anyone that's been through, an insurance policy of any kind, you have to go through underwriting, which means basically some kind of a health exam. I'm assuming some kind of a cognitive test that they're going to give you as well. I don't know to the extent, what else they would do, but it's a review of your medical records, and they come up with a rate class or a determination, or is it just like you're approved or you're not approved?
No, it depends on the company, but generally you're either approved or not approved, and you're approved at a tobacco rating or a non-tobacco rating.
Okay. All right. That's simple. That's simple enough.
Simple.
Okay. So you got to go through an underwriting, and if there is, so like, what are some of the medical issues that you've seen that are generally like, no, we're not going to cover you on this one?
Oh, cholesterol.
Yep.
Pending doctor appointments.
So that's pretty strict.
It's very strict. It's very strict. Very.
Okay. So getting it, the younger, the better is obviously the idea here. Now, what about the structure of how to pay the policy?
Yeah.
Or the types of policies there are. Maybe let's get into that, because I know they have changed over time now.
So what was your question? Something on premiums.
Yeah. So I think so if I don't do the traditional, I'm just paying a premium like the car insurance type, like what is the best type to get?
Yeah. So there's another type out there. It's called hybrid or asset-based long-term care.
Mm-hmm.
And what it is you pay in a set amount of money over a set amount of years. Now that minimum amount, the minimum commitment is always going to be $50K.
Which seems like a lot of money, I know, to people. Right?
Yeah.
That's a lot of money.
10, 15 grand a month for care.
Yep.
It'll surpass 50 real quick.
Yeah. So, but if you're if you own a practice, you own a business, you're doing some of the principles that we've told people to do, you should be able to fund this thing over a period of time, whether it takes you 10 years or 5 years or, doing a lump sum. It is something that, you should be able to have the money to do.
Yeah. And I can do $50,000 all at once and never pay another penny.
Okay.
I could do $5,000 a year for 10 years. I could do $10,000 a year for 5 years. I just have to get $50K into the thing.
Okay. So I got to put a lump sum of $50K. What does that do?
Well, that buys you long-term care benefits starting at your current age.
Okay.
So, and I'll use the example here. I know I can't share it, but I'll use the examples that I ran. So let's say I do that $50K and I am age 42. Okay. Starting today, I'm going to have a benefit of $4,000 per month. Okay. Yep. Now that $4,000 benefit is going to have a cost of living adjustment on it of 3%. So every year that goes up 3%. Got it. By the time I reach, let's say age, let's say age 78. Okay. So you're in the 38th percentile of chances
of being in the facility under 85. But let's say that happens, 78.
My benefit is going to be $11,500 a month.
Yeah.
Tax-free, by the way. Long-term care benefits are paid tax-free.
Okay. And then how long does that benefit pay out for?
6 years.
So it's a 6-year policy, basically.
Yep. And over those 6 years, I would have a total pool of funds available of $890,000.
Okay. So now if you live past that 6 years, then it's, that's the risk, right?
Yep.
Okay. But the statistical probability is that it's going to be less than 5 years in most cases.
Now let's, just for apples to apples comparison, let's take the same scenario. Let's say I get long-term care at age 59.
Mm-hmm.
My starting benefit's only going to be $2,900.
Yep.
And by the time I'm age 88, it's only grown to $5,000.
Wow.
So over 6 years, my maximum amount is going to be $395,000 compared to basically $900,000 if I got it, 15 years younger.
Yeah. If you got it when you were younger and like you said, your prime earning years. Now it's still better than having nothing.
Oh, absolutely.
And, it's never too late. And, usually what is the threshold of when it's probably not a
once
good
you're
benefit?
once you hit your mid 60s, it's not attractive.
Yeah.
You got to get it pre 65.
Okay. So pre 65 is probably a good plan to do that. And then, so the payments then, what happens when, okay, I can't do the activities of daily living. How does it pay out?
And this varies company to company, but the ones we use, they just pay out just a flat amount, just money to you,
mm-hmm.
right? You don't have to submit receipts. It's not a reimbursement. It's just you're eligible for $10,000 a month. We're going to deposit it in your account every month on the 5th.
Okay.
That's simple.
That's it.
And then the other big point to these policies, so not only are you locking in your premiums where you don't have to worry about rate increases,
mm-hmm.
not only are you getting a cost of living each year where it goes up, but if you die without using long-term care, with traditional, you're out the money. With this, there's a death benefit. And if I pay in $50,000, that death benefit's probably going to be $65,000, $70,000. So it's not like a life insurance policy where you pay in $50,000 and you get $900,000.
Right.
But at least I'm getting my money back.
So if
plus
you don't,
a little interest.
Yeah. So if you don't end up using the money, you may have earned more on that money if you would have invested it over a period of time and
of course.
done that. But okay, there's no guarantee on that. And, we've seen people blow money pretty quickly. But at least this, you have the ability to get the money back, or it would go to the estate at that point in time. Okay.
That's the worst case scenario is you die and you get your money back, or your family gets your money back plus a little extra.
Okay. Yeah. I mean, it sounds almost like a no-brainer right now to do this. So people in the 40s, 50s, even 60, it's not too late, but we definitely have to do it so that it's, when you're at least in some kind of peak health. Now, have you seen people that have gotten denied? I mean, and then they improve, then you can go back and try to reapply.
Oh yeah.
I'm sure you can.
Yeah. Like I just had one of these recently. She was mid 40s and got denied because of a pending heart appointment. So a year ago they said nope, and then we reapplied this year. The results were all in her medical records, and she got approved in a week or two. So
excellent.
Yeah, it's their first inclination is to decline you for any reason, and then we can fight it.
Okay. And there's a number of companies that have good structure, good policy, but it needs to be designed correctly. And then you can adjust what the benefit would be by how much you fund it. Now we have to do minimum of 50,000, but if you wanted to, could you put more in there to have a bigger benefit? Okay.
Yeah, and that's one of the ways to offset. Like if you're,
If you're
if
older,
you're 40 years old, 45, you can put in 50K and you can have a nice policy, right? But if I'm
yeah,
62, I might have to put in 100,000 to get those similar benefits.
yeah. And then let's say I start using the benefit and I die after the first year. Would there still be a payout to get my principal back
Yep.
at that point? Okay.
Yeah, if you collect long-term care benefits that are less than the death benefit, your family would get the difference. So
they'll bridge that. So again,
Yep.
you're guaranteed to get the full value of what you put in back at some point in time.
It is mathematically impossible to come out behind unless somebody buys a long-term care policy and then turns around and surrenders it.
Yeah.
And
Gotcha.
I have, in my entire career, I have seen exactly 0 people surrender a long-term care policy.
Yeah, it would be crazy to do it. It'd be crazy to do it. Excellent, man. Well, I think we killed it. That was great. So, just to wrap it up, look, it is a risk. It's something that I think everyone, if you've ever had elderly parents, if you've ever had to see someone go through end of life, it's not fun. Add the stress of how to pay for it. And, and I'm sure that person, who may not be completely aware of everything, certainly is not going to want all of their assets to, go to a facility where they could go to their family.
No.
And, we got to think about that while we are cognitively still aware and, we have the money and the resources to just, bite the bullet. I mean, $5,000 over 10 years or $10,000 over 5 years for anybody that owns a practice, that you should be able to do that.
Absolutely.
You should be able to do that. And that's going to protect, you, it's going to protect your family. It's going to protect, the money that you've worked for. So all around, it really is something that is important that everyone needs to look at. So, all right, Gersh, between two Erics, nice job.
Till
as
next
always.
Time.
Yeah. Make sure you guys like, subscribe, share, do whatever. Tell us what we can do better. Although, I think that was just like probably one of the most perfect,
learn how to use screen share. That's what we can do better.
That we've ever done right there. So I'm just going to just say that we just nailed it right there. Anyway. All right. See you guys next time.